How's it going, chumps? Welcome back to the small count challenge. Haven't done an update in a while, so just a quick sort of recap as to what our original position was. Is that we had a bunch of short-term Jade Lizards for Soxel. Let's see here. Let's take a look at an analysis on this. And pretty much the positions were almost simulating like an iron condor, or like a kind of like a shifted iron condor as a result. Actually, I have two iron condors on here. So there's a bunch of positions here. Let's clean this up. I'll show you the first one right here. This is the first position right here. This is kind of like a skewed iron condor. Soxel is sitting right here. Our current P&L on this position is $75, which is not bad. You can see it right up here, the P&L open for the total at the top. And then we have, 3 days to go. Right now it's 4:30 p.m. Tuesday, March 12th. And so we have basically until March 15th for this to expire. The end of March 15th, so it technically expires March 16th. Then we have another position here. This is the Jade Lizard, practically. Actually, no, it's another Iron Condor, but this one I actually have a infinite P&L to the upside. The current stock price right now is $49.65, and so we are pretty much in the sweet spot for this position right here. So with 3 days to go, we can safely say for both positions, we're gonna basically net profit somewhere along the lines of the max profit. So as long as Soxel either just slowly grinds up or even slowly goes down within the next 3 days. I'm pretty happy about that. Another thing I was trying to do in order to sort of keep things spicy is that today we had a lot of upside movements, and I know that I couldn't do any day trading type of activities, so I decided, okay, what if I were to put in a SPX kind of position, but allow it to just simply go to expiration, just let it run to expiration. That can be on the riskier side, and it can put me in timeout in terms of positioning again, but I decided to risk it. So let's see what that looks like. So what I did was I initially had put on a position where it was strictly just a put vertical. So the put vertical would have looked like this. Too bad I can't show you the analysis on this trade because it's already closed. Oh, bummer. Okay. Well, the put vertical is basically just like a nice solid horizontal line. Imagine it. You see this orange line right here? That's essentially the put vertical there. What I did was, as SPX in the market was just sort of climbing higher, I slapped on a butterfly, actually, a put butterfly. So what happened was, as the price, so imagine that this is my original vertical, I put it on, the stock price just kept moving up, moving up, moving up. This was my chance to basically be able to see if I could capture a top, right, and make some additional money off of it, while not having to contribute any buying power from it because I already received payment for it. So effectively, if it moves backwards, I don't have a downside movement. I just have less profit. And if it moves up, I have more profitability as a result. So the put butterfly consists of two long puts and then two short puts smacked in the middle. And when I add, and this is what it looks like by itself. So this is a put butterfly. It spikes in terms of profitability, but this is the amount at expiration, so that's actually kind of beneficial when it comes to a 0 DTE. And then of course there's negative profitability as a result, and the negative profitability is infinite to the downside at a certain point, and the max negative profitability is $355. However, my put on this side is $295. So as long as it stayed somewhere in the range of where I was looking for, right around here, the max, like a hypothetical and more realistic P&L loss would have been $60 tops if somehow the market just completely toppled over right around this point. And mind you, we were already sort of moving, I would say, an hour or two just before closing when I decided to put, I'd say 3 hours before closing when I put this butterfly in. So when I put the butterfly in, it effectively is being paid by the original vertical, combined with the fact that if it were to land at 170 or around there, I'd get a huge bump in profitability. In fact, the max profit would have been 905 if it had landed right smack at 170. Anywhere near it would have been close to the 600 range, but it actually landed at 5,175. So that profitability was 400. What I took home was 440. Not bad for a one-day trade. And at the same time, I don't get flagged as a pattern day trader because I didn't make a round trip. I let this expire. So this is technically my loophole to be able to trade SPX on a daily basis. The caveat is I have to, and I have to let it run. So in those instances, I'll probably only do verticals because it gives me the most protection in one direction of a trade. And then simultaneously, if I see that my direction is correct, I may layer on a position that is basically spoon-fed by that, by the previous vertical. So then that way I can effectively let it run. And if I let it run and I know that it will not sort of get, blown out of the water, which is kind of tough, but I can still make that judgment call. I can still close the trade if that's the case. It just means that the account will get flagged and I have to sort of wait it out again. So that's sort of where I'm at in terms of how I'm kind of playing the game of both doing a longer term kind of position and at the same time a shorter term. So these will expire in 3 days. These are already expires and the P&L is already in there, and we are already off to a good start with a half a grand for today. So now that we are at $4,000 on the account, let's make it to 5. Hopefully within by month's end. All right. If you have any questions, please leave it in the comment below. I'll catch you on the next one.